We saw in previous videos that the combined statement of financial position was about a point in time. So at the end of the year, the 31st of December, this is the organization's assets. Also in previous videos, we saw that the assets were things that the organization owned, and that there are different elements of measurement done with each asset. Measurement rules about the amount we show as cash and cash equivalents. What exactly are investments and what does that amount mean? The same with accounts receivable. Accountants spend their entire college years learning how to do the financial reporting on each of these items. So in college, you may have 2 weeks on just cash. What is cash and how do you measure it? 2 weeks on maybe 3 weeks on investments. What are investments and exactly how do you come up with that number? A week on receivables. There's lots of nuances. There are different valuation methods for each kind of asset. In general, our current assets are recorded at about what we could get out of them. That brings us to our current asset definition. Current assets are assets that are available for current operational issues. What do you have to start a new ministry? It is going to be in that pile of current assets somewhere. In addition, we might have some very current cash accounts that are down here in non-current assets because they are not available for operations. Now we move down the balance sheet. Here's the land, building, and equipment carried at depreciated historical cost. Then moving down, we pass through the other non-current assets and get to liabilities. The assets at the top of the statement of financial position are the things that the organization owns. Then at the bottom are the liabilities and net assets. They are the creditors and the owners claiming the assets. The bottom is the claims against the assets at the top. So liabilities are the claims of the creditors. These are what we owe. Now this is sort of simple. They are typically shown at very close to what we would have to pay to get out of them today. That is not precisely correct, but it's a good working start. They do not include future interest that we will have to pay sometime in the future, and they do not consider penalties for early payment. Accounts payable would be what we owe current suppliers, the electric company, for example. We might easily have something that we owe to employees, like salaries payable. Then the offerings and agency payable. We'll talk more about that in just a second. Loans payable would be notes that we have signed, like car loans, where we borrowed the money. The current portion of that loan is the amount that we owe in the next 12 months. And then there's the non-current portion. So we have to add the two together to get the entire loan amount. Here on these financial statements, we have loans payable current of $697,450 and the non-current loans payable of $2,140,744. The total of the two is the amount the total balance of the note. Liabilities are fairly simple. We all have them. One point is to make sure that we do not get confused. These are debts that we owe. These are not expenses such as my electric bill. If I've paid my electric bill, I do not have a liability. If I have not paid it, I have a liability. If I have borrowed money to buy a conference vehicle, I have a liability for what I owe the bank. But if I have to pay the insurance company every month, that monthly bill is also a liability after it is due if I haven't paid it. But if I have paid it, it is not a liability. Don't get liabilities confused with my monthly bills. Not all debts are created equal. There are two different classes of debt. I do not want to be too elaborate here, but I think an example would be helpful. Suppose I were to say to Fred, "Fred, would you go to the store for me and buy me groceries on this list?" And Fred is a good guy, and he says, "Yeah." I say, "Here is £100 to spend and just bring me the change." When Fred comes back at me, he looks sheepishly and says, "Mac, I'm really sorry. I spent the money on a television for the family. I want you to note, though, I know I owe the money to you, and I will pay it to you as soon as I can." It is true that Fred has a liability of £100. Fred has betrayed what is referred to as an agency relationship. An agency relationship is when you are holding money on behalf of someone else. Fred was holding money on my behalf, and he was my agent. This is completely different than my dealings with Tom. Tom comes to me and says, "Mac, I'm a little short. Could I borrow £100? In this case, I'll look him over and decide whether he will pay me back or not. I decide he's okay, and I loan him £100. He, too, has a liability to me of £100. Now, both Fred and Tom both owe me £100, but you can see the substantial different circumstances. Fred has betrayed the agency relationship. He essentially swiped the money because against my will, and he owes me $100 he got as my agent. And Tom, to whom I'm with my eyes wide open, I loaned him £100. They both owe me £100, but substantially different circumstances. So the liabilities we owe as an agent are a higher level of trust than what we owe as a normal debtor. Misusing or withholding money I received as an agent is fraudulent, while not repaying your debts is simply bad. Let's apply this to a conference. In one case, it has borrowed $30,000 from the union. The union goes into that deal well knowing the financial condition of the conference. Not repaying this loan would be a betrayal of a promise, but it is not as serious as not paying money it collected as an agent. In the case where it is collected $30,000 a tithe, it owes $30,000 to the union, but it has collected it as an agent. Not repaying that money is a fraudulent, since it is basically, the conference would basically be strong-arming the money that belongs to the union. Both show up as $30,000 liability on the conference, but not repaying the agency debt is much more serious. Because of the closeness of Adventist organizations, agency relationships and agency liabilities are everywhere. The most obvious is tithe collected as agent by the local church and then held by the conference. But we also are passing around donations made by the GC, but due to a conference. Then there are global mission funds flowing through our union for a conference project, or a school holding a students' club's money, or a division appropriation for a university flowing through a union. All of those are agency relationships, and they have a different level of trust than a simple debt. I hope you see the difference. They are all liabilities that result from people trusting us. We want to make sure that we put special glitter glue highlighting our agency debts. This $7,200,452 is what we hold as a trusted agent, and we're betraying trust if we do not pay that onward. For that reason, we have segregated the cash that we owe and hold as agents. Look at cash held in agency. That way, we don't get the wrong impression that we have more cash than we actually have. Now, I will tell you that this illustration in the accounting manual is a little bit off. If it were done correctly, the cash held in agency would be equal to the agency liability. We have one more little item and then we're done. How do you tell the difference between a current liability and a non-current liability? Again, the definition is residual. That is, if it is current, it is current. Then everything else is this other non-current liability. If you understand what is current, then you will, by default, understand what is non-current. The quick answer that most treasurers will throw out is a current liability is a liability that is due within 1 year. It is slightly more complicated than that. There's symmetry between the definition for current assets and current liabilities. Current assets are those assets that will be converted to cash in a year and are assets that are available for operations. This last clause excluded cash and investments that were earmarked by the donors of the board for building and equipment. I know you've heard that definition about 10 times. The definition of current liabilities mirror the definition for current assets. They are debts that will be repaid in the next year out of current assets and operational resources. What that means is not overwhelming. The main point of the definition is to emphasize that current liabilities are an immediate burden on current assets. At least conceptually, the first thing that you will do with your current assets is to pay your current liabilities. This concludes our video on liabilities. Our next one is on net assets. They are also down here at the bottom of the statement of financial position. They are the second category of things that have claims on the assets. There are similarities between liabilities and net assets, and there are differences. So stay tuned to the next video.